A very good morning and a welcome to the fourth edition of HSBC's SME Knowledge Series with our knowledge partner, CRISIL. Today's session is called Catalyzing Chemicals Amid the Crisis and Opportunity for Chemicals and Plastic Industry in India. I'm very glad to see a lot of our customers here today, and I hope you will have an enriching session. Without further ado, let me start. We have some housekeeping rules for today, which we will start before I introduce my first speaker for the day. All attendee lines will be muted and video for you will be disabled during the session. The Q&A option on the menu bar at the bottom of your screens, whether you are on your phones or your laptops, will be open throughout the session. This is especially there for you to ask your questions. You can start asking questions right now itself. However, due to paucity of time, we may not be able to take all your questions. But don't worry, post the session, we will be sharing the presentation, the replay, the podcast, the Q&A, everything with you in a phased manner. Without further ado, I would like to introduce my first speaker for the day, Mr. Jaideep Singh Kalra. Jaideep has been with the bank for over 20 years and is currently the director and head for the North India Business Banking Unit at HSBC Commercial Banking. Over to you, Jaideep.
Thank you, Subhash. And I hope I am clearly audible to everyone.
Absolutely.
Great. Good morning, and thank you indeed for sparing your valuable time on this very auspicious day, Janmashtami. I'm very pleased to welcome you to this fourth episode of HSBC SME Knowledge Series with our partner, CRISIL Research. These are trying times, and we know that our clients are looking to rebuild their businesses. This rebuild needs to move at pace. This is very important to help support both the businesses, the economy, and also social imperatives for a large country like ours. The moot point is how well are we addressing the specific challenges and opportunities being thrown at us with this pandemic. And some of these challenges are again very specific to the business and the industry that we operate in. At HSBC Business Banking, we have partnered with CRISIL Research to help you with insights into 8 key sectors with a very specific MSME focus and the opportunities, challenges that they present to MSMEs. We have covered packaged foods, agri-inputs, pharmaceuticals in the last 3 episodes, and today we plan to cover chemicals, plastics, and IT and ITES in the next one on 28th August. Chemicals and plastics underpins almost every single manufactured product. And the CRISIL team will take us through both the macro and the micro developments across the entire value chain, basic, specialty, and niche products, and the very important demand outlook in these uncertain times. Do reach out to our experts for a Q&A session towards the end of the presentation. I think in today's connected world, it would be fair to say that knowledge and agility are both seen as key to success. While we gain knowledge, at HSBC Business Banking, our aim is to be the leading bank and solution provider to micro, small, and medium enterprises in India as well as overseas markets. And I'm glad to share that we have recently been awarded as the best bank for digital innovation, as well as the #1 banking brand in Asia for 2020. But the proof of the pudding is obviously that how we engage and help our businesses during these difficult times. I would now like to start today's session by introducing Ms. Deepti Deshpande. She is a senior economist at CRISIL. Deepti is also part of the Standard & Poor's Asia Pacific Economic Research team. Prior to joining CRISIL in 2010, she worked with the institutional equities research business and has 12 years of rich experience in the field of macroeconomic research. Some of her recent work has been in the field of inflation, monetary policy, the quality of Indian growth, tracking, studying monsoons and global developments and their impact on India. Thank you for being here, Ms. Deshpande. Over to you now to take us through the macroeconomic outlook. Thank you so much for attending the session. I look forward to interacting with you later.
Sure. Thanks, Subhash, and thank you, Jaideep, for setting the context. A very good morning to everybody. Economic conditions, we all know, have slid precipitously ever since the COVID pandemic has hit us. What initially looked to us like an external shock, which would send few ripples through India, perhaps mainly through its external and trade sectors, quickly transformed itself into a large, pervasive domestic shock. Now, a holistic view at the look at the entire scenario suggests that the damage has been significant across the board and enduring in a few sectors. Coming out of this is an even bigger challenge given that the Indian economy was already on a weak footing and policy muscle is limited to stimulate a rapid and sustained revival. What makes this all the more challenging is that policy making is based on a trade-off between loss of lives and loss of livelihood. Days to come will bring key challenges in our view. The way in which households and firms spend, access services, save, and also invest. One definitive key change in the forthcoming quarters is that the role of the government in driving growth will inevitably rise. If we can move on to the first slide, I'll quickly take you all through our initial views. In our base case, we expect GDP to fall 5% in fiscal 2021, that is the ongoing fiscal year. The nationwide lockdown in April and May, the most stringent in Asia to note, continued periodic outbreaks in key metros, and tightening of social distancing measures, and some recent loss of momentum and activity have all taken a toll. The economic costs of which are much higher than what we initially expected. In this gloomy backdrop, agriculture somewhere is acting as a beacon of hope. This will be the first year in 70 years for India when GDP contraction will be led by the non-agriculture sector. In the previous 3 occasions when GDP did contract in India, it was agriculture and primarily monsoon failure that was to blame. Overall, good performance of agriculture augurs well for rural demand as well. With a large number of migrants moving back, the dependence on agriculture and farm incomes is even higher this time than it has been in the past. But a bigger challenge compared to other countries that India is facing is that our immunity was low when COVID struck us. Consumption was weak, private corporate investment was also weak, and we were in fact waiting for any sort of signs of revival. The financial sector was under stress and continues to be under stress, and government finances are stretched. Domestic vulnerability, therefore, is on the rise, bringing about a risk-off scenario. Then again, the fiscal support has been small, given tight government finances. Now, the central bank has extended several measures in the last couple of months to ease credit conditions. But risk aversion in the economy means that lenders are wary to lend until there is visibility of A, demand revival, and B, assurance that money lent out will be paid back. All this has led to financial conditions being tight and overall demand conditions staying weak. Policy impact on growth, therefore, so far remains fairly muted, except in pockets. Putting all this together, that is the deep hit from COVID, low immunity to begin with, and limited policy push to growth, implies that our ability to catch up with our trend level or pre-crisis level of real GDP in the coming years is going to be low. So we estimate this loss of not being able to catch up to trend at about 10% of GDP over the next 3 to 4 years. Also, given the recent loss of momentum in economic activity, especially what has been seen towards end of June and mostly July, the downside risks of our GDP forecast have now amplified. Moving on to the next slide, I think it's important to mention the assumptions on which most of our forecasts are premised. And there are 2 or 3 very key assumptions that I would like to mention. The first key assumption is that the pandemic peaks out in the current quarter and there is no second wave to begin with. Second is that we are assuming or we are baking in another fiscal stimulus package to the tune of 1% of GDP, which would perhaps come forth towards the end of Q2 or even Q3. A significantly important assumption is that of a normal monsoon that supports rural economy, especially in states where the agri share in GDP is higher and non-agriculture activity has been hit by relatively higher number of COVID cases. Finally, I think if you look at how growth is expected to pan out, we believe manufacturing could revive faster while services will lag. Overall, we expect Q1 to be worst affected, but recovery in Q2 has also been wobbly if you look at high frequency indicators. So economic activity will remain fairly subnormal this quarter too, and we only expect growth to enter the positive or mildly positive zone from Q3 onwards. Going beyond, we believe fiscal 2022 will see a growth spurt similar to what is expected also globally. So growth could waver around 8% on a weak base, some impact of fiscal stimulus, some pent-up demand as well, and more so a rising tide effect, because if the global economy is expected to see a significant pickup next year, some impact on India, especially through exports, could be expected. But to be honest, we need to mention the downsides, or rather underline the downsides to these forecasts, since those have accentuated. We've seen some regions see a significant challenge battling COVID cases and reintroducing of containment cases, etc. It's also a fact that number of Asian economies have started seeing a second wave of the disease. So if at all that comes forth, that can have a significant hit to growth. The second downside risk comes from the fact that any further worsening of stress in the financial sector can be a drag. And finally, global GDP as of now is expected to fall close to 4% by S&P in 2020. The overall understanding is that health and economic shock appears to have peaked out in most developed economies as well as China, though many emerging economies continue to struggle to contain both the virus as well as the economic fallout. The risks, however, are seen tilting on the downside for one or two reasons. One is that the recovery is taking longer than expected and is also weaker than expected. And second, given the huge debt burden, the fear is that a couple of economies shouldn't prematurely start tightening their fiscal policies, which could have a significant hit to growth. Slower global growth automatically will have and is having a bearing on India's exports. Currently, the external sector measured by the current account or trade deficit is looking strong. But most of that strength is because imports, mainly core imports of investments and consumption-related goods are plummeting. Exports are also contracting, but the pace has slowed down in the last 1 or 2 months. Broadly, we see manufacturing exports having been hurt the most, especially engineering goods, textiles, gems and jewelry, petroleum products, etc. Chemicals and agriculture products, meanwhile, seem to be doing a little better. At least this is basis the macro data that's coming out from the Ministry of Trade. On the whole, exports are suffering, and any hit to global growth can have a bigger impact. With this, I'd like to end the broad coverage on macro outlook. We can take any questions as required in the as that come in the Q&A session. And I'll hand this over to Mayur to take us through the rest of the segment. Thank you.
Thanks, Dipti. A very good morning to everybody, and I'll be taking you through the session on chemicals and plastic. So I will start with the flow of the presentation. We will start with chemicals value chain and briefly look at commodity price outlook for crude and ethylene. Then I will talk about the Indian chemical sector and India's positioning in global trade. Subsequently, we will look at what India needs to do to improve its export shares. Further, we will also focus on the segments with higher share of MSMEs, the colorants and plastic product segments. We will specifically look at the value chain, demand, impact of COVID on these segments, and financial performance. I will then conclude by talking about opportunities in these segments. So let's start by looking at the chemical value chain. Chemicals chain is an intricately linked chain where downstream segments depend on key feedstocks such as naphtha, natural gas, petrochemicals, and bulk chemicals. Bulk or basic chemicals like petrochemicals and commodity chemicals are more organized in nature as they are more commoditized products which go into multiple downstream applications. Capital expenditure here is very high due to the scale of the plant, which restricts entry of small players. Specialty chemicals, on the other hand, is more fragmented market with small plant sizes, since these are niche chemicals which find utility in specific applications. In this case, R&D cost is higher as players need to reinvent to cater to specific needs of the clients. As plant sizes are small, entailing lower investment requirement and no major technological requirements, presence of SME segment is higher. Most of the chemical products find application in multiple end-use industries like auto, construction, packaging, pharma, textiles, consumer durables, etc., and have close linkage to the economy. Since the chain starts with crude, it is important to understand what is our expectation on crude prices in FY21, as this will directly influence our feedstock and product prices. So let us look at how crude prices are expected to move. Crude prices have been very volatile in the last 4 months, with prices touching a low of $20 per barrel in April from about $50 in just a month. As COVID struck, demand for crude dropped by 25% as countries went into complete lockdowns and all economic activity as well as travel came to a sudden standstill, impacting industrial and transportation activity. With concerns over demand growth, OPEC decided to cut production by a record 9 MBPD. Despite of this, we saw inventory levels increase in June as demand drop in the first 6 months was higher at 12 to 14 MBPD as against supply cut of around 7 MBPD, as you can see in the top chart. As most of the larger economies go into recession, demand will severely be impacted during the year. Hence, we expect prices to range in the $40 to $45 per barrel, supported by some extent by the production cuts. Now, since ethylene prices move in line with crude and naphtha, we saw a drop in ethylene prices as well. However, more than input prices, ethylene market has been impacted by huge capacity buildup over the last 3 years, leading to an oversupply situation. This comes against slowing global demand growth. So cracker margins have declined as drop in ethylene prices was much sharper than naphtha prices in the recent past. As we expect more supply additions in 2020 of around 8 million tons, while demand stays subdued, we expect ethylene prices to remain in the $650 to $700 per ton level, and cracker margins to range in the $150 to $200 per ton level. So now that we have looked at the commodity price outlook, let's move to the chemical sector as a whole. India's chemical industry is the third largest in Asia in terms of volume, and it accounts for around 3% of the global chemicals industry. However, if we look at the per capita consumption, India ranks far below countries like China and developed economies like US. Though usage of plastic across applications is on a rise, per capita consumption at 10 kg is significantly lower than China and the US. Along with domestic growth, what has supported growth in the chemicals industry is the exports. India's chemical exports increased at 10% over the last 5 years, with the share of chemical exports in overall exports for India increasing from 8% to 11% during the same period. If we look at the key segments within chemicals, specialty chemical segments grew at a faster pace of 8%, driven by high export penetration. For India, share of specialty chemicals in the overall chemicals market has improved from 20% to 22% in the last 5 years. So over the next 5 years, we expect overall chemical segment to grow at around 4 to 5% as economic growth recovers from FY22 onwards, as well as India's penetration in export market improves further. So with this, now let us look at what's India's position in the global trade. India is currently a net importer of chemicals, mainly on account of lower capacity additions in the past and competition faced from imports mainly from China. Being a net importer for most of the basic petrochemicals resulted into limited downstream capacity additions. If we take example of ethylene and propylene, it is majorly consumed in making downstream applications like PE and PP, thus restricting capacity additions in the ethylene and propylene derivative side. This has restricted capacity addition in downstream chemicals and products where India is largely dependent on imports. However, the only segment where India is a net exporter is specialty chemicals. Exports are mainly in colorants and agrochemicals, which grew at a CAGR of 11% over the last 5 years. Colorants players have been able to penetrate export market due to their product portfolios, cheap labor, as well as compliance to norms. So with this backdrop, let us look at export of specialty chemicals a little more closely and the countries with which India competes. Global specialty chemicals trade grew by around 3 to 3.5% over the last decade. with share of Asia increasing from 42% to 52% as manufacturing shifted from Europe to Asia. If we look closely at the specialty chemicals trade, China, US, and Germany account for a larger share. Though India's share is lower at 7%, it has almost doubled in the last 10 years, with India's export growing at a faster rate of 10 to 12%. Slowdown in China's export over the last 5 years due to stricter environmental norms contributed to India gaining share in the global trade. India is the largest net exporter of colorants globally and fourth largest in agrochemicals, with majority of the exports to countries like Brazil, US, France, Vietnam, and Belgium. In fact, for colorants, India's share in world exports increased from 15% to 19% between 2015 and 19, while the same for China fell from 24% to 21%. So clearly, India has sort of gained advantage at the cost of China. So having looked at India's increasing export share, let us see if India can become a major player in the global trade or the export side. So some of the growth drivers for India will be the ongoing US-China trade war, environmental concerns in China leading to closure of units in China, changing global demand-supply dynamics in the current environment, where more countries wanting to diversify their supply chain and reduce dependence on China, and obviously India's competitive labor cost. While areas where India needs to improve are R&D spend while reducing dependence on imports and increase scale of production. So now let's see how India compares across various parameters with other countries. If we compare India to China, US, and Europe, India clearly scores high on the labor cost front. India's labor cost is almost 1/3 of that of China and significantly lower than US and Europe. In terms of environmental norms, India is better than China, as India has well-led process in terms of pollution control norms, while China has been lax on this aspect over the last decade while it was scaling up. This will also lead to increase in compliance cost for China, further impacting its cost competitiveness going forward. However, procedural delays in case of India to provide clearances does impact the project timelines, which is a sort of negative as compared to some of the other countries. R&D spend is an area where India needs to catch up with its peers, as R&D spend as a percent of sales for US, China, and Europe is far higher than India. Though India's R&D spend, especially by the specialty chemical manufacturers, increased at a 23% CAGR over the last 5 years, it still lags behind most of its competitors. Finally, India lacks scale of production as compared to the other 3 countries. In terms of production value, Germany is almost 2 times that of India, while US is almost 7 times, whereas China is staggeringly high at around 18 times. So to conclude, India needs to focus on reducing its import dependence by building scale capacities and also improve R&D and to keep an edge in the products offered. Now let us understand how the COVID situation has impacted the chemicals industry. Industry growth had already slowed down in FY20 due to slower economic growth and falling realizations. COVID-19 will further slow down growth across key end-use industries. Demand in auto, consumer durables, packaging, textiles is expected to decline sharply in excess of 15% as consumers restrict discretionary expenditure in the present times of uncertainty. These segments account for a higher share in overall chemical demand. So we will see the demand for petrochemicals and commodity chemicals drop by almost 20 to 25% as both volumes and realizations take a hit. In specialty chemicals, the decline will be slightly restricted as some subsegments like surfactants and agrochemicals, the decline will face a lower impact. Increased usage of hygiene and cleaning products will keep demand for surfactants high, whereas higher sowing activity on the agriculture side will drive agrochemicals demand. However, segments linked to other broader sectors as well as exports will see a sharper decline. We see the scenario reversing in FY22 with economic recovery leading to growth across segments. Let us now move specifically to the specialty chemical segment and the colorant segments. Specialty chemicals industry showed a healthy growth of around 8 to 9% over the last 5 years, mainly driven by growth in larger segments, agrochemicals and colorants. These 2 segments also have a higher proportion of export revenues, with exports constituting almost 50% of their market. At an overall level, the share of export revenue stands at 30%. Most of the specialty chemicals find application in multiple end use, resulting into steady growth. Sectors like auto, industrial, packaging, textiles have performed well over the last 5 years, driving growth for specialty chemicals along with increasing export growth. These sectors generated requirement for new applications, which were catered by the players, thus driving the incremental growth. Since these are niche products designed to meet specific requirement of users, players consistently try to improvise. Also, what we have seen is players in the specialty chemicals have also expanded their capacities and made investments to address the opportunity both in the domestic as well as export market. Almost rupees 140 billion was invested over last 3 years in the specialty chemical sector across subsegments. Most of the players have also gone public to raise resources and fund the capex. So we have seen a lot of traction in the specialty chemical space over the last 5 years. So with this backdrop, let us move into the colorants industry, that is the dyes and pigment segment. Colorants industry in India is estimated to be around 410 to 430 billion in terms of market size in FY20. Dyes and dye stuff account for 75% of this share, while rest is accounted by pigments. India is a leader in reactive dyes due to ample availability of raw material vinyl sulfone, while China is a large player in the dispersed dye side. As a result, India does not directly compete with China in the dye segment. The industry is moderately fragmented, with 60% of the market being organized with top 5 players, accounting for around 25% of the market. But rest of the market is catered by around 800 to 900 manufacturers in the industry. This is because dye stuff manufacturing is not technologically intensive, and it is also less polluting as compared to dye intermediate segment, resulting in lower compliance cost. Dye intermediate is a more organized market with presence of a few players, as getting environmental clearance is a tedious process and prevents small players from entering this segment. Though the domestic production is concentrated, India along with China is amongst the largest producers of intermediates. However, margins in this segment are relatively higher, as players have the ability to pass on higher price to the dye stuff manufacturers. Though India is almost self-sufficient in dye intermediates, it is a net importer in both base chemicals as well as inputs, which are required in manufacture of dye intermediates, especially like H acid and gamma acid. So now moving to the next slide, looking at the COVID impact. COVID-19 is expected to impact both domestic and the export demand growth for colorants. Textiles, printing inks, and paints account for around 75 to 80% of the demand for colorants. Firstly, talking about domestic demand, production cuts in the downstream industries such as textiles, paints will reduce offtake of dyes and pigments in the first half of FY21. Even in H2, no major recovery is expected from end-use segments such as real estate and automobiles, which will reduce demand from paints. We expect paints demand to fall by around 18 to 23% due to weak demand sentiment. Even in case of textiles, the recovery is expected to be gradual in the second half as people restrict their expenditure on discretionary items as they would be working from home. Also, labor-related issues, labor availability issues especially, are impacting the sector. Hence, we expect textiles demand to fall in a similar range of around 18 to 20%. We expect domestic demand for colorants to decline sharply by 12 to 14% in FY21. Coming to exports, scenario will be even worse as exports account for 55% of the demand for colorants. India majorly exports to countries like China, the US, Turkey, and Bangladesh. Due to the pandemic, countries like US and Turkey will see imports from India decline in excess of 30%. Hence, we expect India's overall exports to decline by 15 to 20% in FY21. As a result, demand destruction in both domestic and export markets will hit hard the performance of MSME segment in FY21, as MSMEs account for around 40 to 45% share in the colorants industry. However, the silver lining in all this is that we expect things to improve from FY21 as economic growth forecasts are buoyant or for all nations due to lower base and the pandemic spread being controlled. We expect colorants demand to increase at a CAGR of 4 to 5%, mainly driven by exports over the next 5 years, growing faster than the domestic demand. So lower demand growth will definitely impact the player performance. We expect revenues to decline by 15 to 20% in FY21 due to spread of COVID. Since raw material cost accounts for almost 75% of the overall cost, it has a higher impact on the margins. However, in FY21, increase in intermediate prices due to supply constraints, coupled with lower realizations due to weak demand, will put further pressure on margins. Lower crude oil prices and slower demand globally will lead to decline in input prices, which will help offset some impact of the revenue decline on margins. The pandemic has hit production of plants, resulting into lower cash flows for small players. A cascading impact of the current situation will also lead to stretched receivables, impacting liquidity further. As a result, their borrowings, especially for short term, are expected to increase, resulting into higher gearing. A lot of players had announced to add capacities in the dyes segment, but some of these may get delayed or postponed, considering the current weak demand scenario, as well as stretched financial position of players. So with this, now let us move to the plastic product segment. The plastic industry chain can be classified into polymer manufacturing, called upstream, and plastic processing industry, where polymers are converted into products, also known as downstream. The upstream segment is organized and dominated by large players. On the other hand, the downstream segment is highly fragmented, comprising of micro, small, and medium units. At present, there are about 30,000 registered plastic processing units, of which about 75% are in the small scale sector. The sector, however, accounts for only 25% of the polymer consumption, while the rest goes to more organized segments, since the industry also consumes recycled plastic, which constitutes about 30% of the total consumption. The higher fragmentation of the processing industry is due to low capital intensity, adequate availability of raw materials, and low entry barriers. Industry also faces direct threat from products dumped by Chinese manufacturers. Hence, Indian players have been requesting for anti-dumping duty to be levied on plastic products to safeguard small domestic manufacturers. In the wake of current situation, government may actively consider this, and there is a likelihood that government might impose duties on this front. So this comes as a positive for the domestic industry. In terms of the end use, most of these plastic products are widely used in household appliances, automobiles, pipes, packaging, etc. Let us now look at the impact of demand on COVID. Plastic products demand is expected to be hit due to sharp decline in demand from end-use industries. A nationwide lockdown will impact packaging segment and demand. However, some respite could come from the food packaging, which has been resilient and used in single-use plastic. Since demand for PPE kits, gloves, and face masks remain high, and as government is currently not focusing on the single-use plastic ban in the current environment, this segment will see some traction. Other major segment, which is automobiles, was already reeling under pressure from higher cost of vehicles, as well as change in regulatory norms, will see a demand drop by 20 to 22%. Restricted spending in the current situation will deter expenses on the discretionary products like consumer durables, resulting into a sharp drop of 33 to 38% as all the major segments in white goods will be impacted. Finally, construction will see a slowdown as investments in irrigation may be lower due to state budgets being constrained due to lower tax inflows and higher expenditure on healthcare owing to COVID. So this will impact demand for most of the polymers and plastic products. However, we expect demand for most end-use industries to revive in FY22 as the economy picks up. Especially segments like consumer durables will see sharp increase in demand driven by pent-up demand from FY21. Now linked to end-user sector demand, plastic products demand is expected to decline significantly by 20% in FY21, over and above the 10% degrowth we saw in FY20. The two key clusters for plastic processing, Mumbai and Chennai, will be hit. Chennai mainly due to the severe slowdown in the auto industry, while Mumbai has faced additional pressure due to the plastic ban. While there is some recovery that has been seen in the Delhi cluster. Economic recovery post FY21 will lead to revival in demand for sectors like packaging, construction, consumer durables, and even auto. India also has ample opportunity in terms of lower penetration of plastics that will drive growth. In addition, new opportunities are emerging in the engineering plastic segment, especially in the auto side. Higher safety standards, advancement in car features, and gradual rise in penetration of EVs, which we will see going forward, will help drive demand for engineering plastics going forward. One key risk that the sector faces is implementation of single-use plastic ban, as it has impacted demand for PS and some applications in P and PP last year. States like Maharashtra, Orissa, Goa, AP had implemented the ban. At present, the pandemic has shifted focus of the central and state governments away from the stricter implementation of plastic ban due to its use in PP kits. Though we see adoption of the ban going forward as a key monitorable, particularly for the SME segment. Consequently, demand from plastic product segment is expected to grow by 3 to 4% over the next 5 years. So driven by slowdown in the end-use demand, plastic product segment revenues are expected to drop sharply by 18 to 20%. Moreover, decline in realizations following lower input costs will further impact revenues. Lower revenue growth will lead to decline in margins despite a sharp drop in raw material prices. Raw material cost, which includes polymers like P, PP, PVC, account for 75% of the overall cost. A sharp fall in polymer prices for the second year in a row would have ideally helped players to maintain or improve margins, but for a sharp fall in revenues, which will reverse the impact. As cash flows get impacted, a bigger worry is that players will face liquidity crunch. Hence, we expect working capital days to increase further and players resorting to short-term funding to offset the lower cash flow impact. In the current situation, players are also finding it difficult to get better credit terms while they need to provide higher credit to their customers as lower demand and higher competition restricts bargaining power. So to conclude, plastic product industry, which sees very high competition due to presence of large number of small players, will see performance further impacted due to the COVID-19. To summarize, the industry will see an impact due to COVID-19 FY21. Since MSMEs account for a significant share in specialty chemicals and plastic product segments, their performance is expected to take a hit. However, from a medium to longer term perspective, the chemical space opens up a number of opportunities for the MSMEs. Specialty chemicals, which will provide big opportunities for exports, as India will benefit from the change in global trade dynamics that we discussed earlier. On the plastic product side, emerging applications, both in the plastics and engineering plastics, especially on the auto segment as well as the electronics, will change the industry. Is experiencing, will benefit players present in this segment. As India scales up petrochemical capacities, availability of raw materials and inputs in domestic market is likely to improve, further providing an edge to players in the downstream segment. So the Indian chemicals industry offers immense growth opportunities over the longer term. So I will end my presentation on this positive note and pass it on to Subhash for Q&A.
Thank you, Mayur, for an extremely comprehensive as well as encapsulated message on the chemicals and the plastic sector. We've already got some questions in for you. Ladies and gentlemen, I'd like to let you know that the Q&A option is open at the bottom of your screens, whether you're on your mobile phones or your PCs. You can please put in your questions and the CRISIL analysts and experts will take them. So Mayur, I'm going to go with the first one. I think this is for Dipti. In case the risk factor accentuates, what is the bear case GDP forecast? I think this is from the macroeconomic outlook for Dipti.
Yeah, sure. So I think we are not going with a bear case. I think its numbers are really difficult to pinpoint at this moment, more so because there are too many moving parts. Also, if you'd see the risk factors that I did mention, there are 2 or 3 moving risks. So for example, in case of a second wave and activity shuts down again, that could be a really big downside to growth. On the other hand, if we don't really face that, second wave containment is possible, but the risk emanates from the financial sector, then the ability of the financial sector to lubricate any pickup in growth or sustain any pickup in growth gets affected. So I think the downside to GDP in that case may not be as significant. The third risk that I spoke of is global. On the global front, if there is a significant downward forecast in global growth calls, then exports, on the export side, we could see some bit of a hit. But if everything is okay on the domestic side in terms of containment, maybe, us being more so a domestically driven economy, GDP may not, get hit to such an extent. So I think it's more of a scenario-based understanding rather than one thing that can be plugged in. Right now, we are honestly waiting for 31st of August when the Q1 GDP numbers come out. And our expectation is that of a minus or a 25% drop in GDP in Q1 and somewhere like -6, -7% GDP growth fall in Q2. But we'll have to really look for that Q1 number to reassess our forecasts for FY21. So to reiterate, it's really difficult to pinpoint on a number on the bear case at this moment. Hope that answers the question.
Sure. Thanks, Deepti, for that comprehensive question. I'll come back to Mayur now. So Mayur, when you say, by increasing R&D and scale of production, we have hope, it's not as plug and play as we may think, right? It may take a year or a lot of years of investment to build this capacity. There seems to be a neglect. How do you see this mindset change for the growth for the chemical industry and the plastic industry to come through?
Okay. So yeah, I agree to that point. So it's not going to be an immediate shift. It's going to take some time for players to develop capabilities. But if you look at the specialty chemical segments, especially, what we have seen is that players have geared up in the last 5 to 7 years, and especially in the last 2 to 3 years, since you saw issues with China. So China's environmental issues actually led to some closure of plants, because of which Indian players gained opportunity. And they have been able to create a strong foothold in most of the export markets, improve their R&D expenses. As I also mentioned, that R&D spend for specialty chemical segment increased by 23% over the last 5 years. So obviously there is a traction which we are sort of seeing. Players are taking action. The larger players are making investments and towards having higher R&D facilities, inventing or improvising new products. But all said and done, there is also one more thing which India needs, that is in terms of the support from government on the infrastructure side. So government has been previously talking about setting up these PCPI regions, which will provide ready facilities, infrastructure facilities to the chemical industry. However, the progress on this has been fairly slow, and which has also impacted setting up capacities both on the upstream and the downstream side. So the process has to start somewhere. The strong foothold that India has in some of the niche and specialty chemicals is where India can leverage to sort of start investing more on the R&D side. Whereas, on the other aspects, obviously it is going to take some time, and India can develop, capabilities as we move along.
Okay, thanks, Mayur. Moving on to my next question. Can you please highlight on the engineering plastics front for the auto industry? How is the demand? What are the growth opportunities for companies? And what are some of the risks that you foresee for them?
Yeah, so specifically on the engineering plastic sides, I may not have the numbers, but what we are increasingly seeing when we talk to the auto players, auto component players, is that there are two shifts which are happening. So in the auto industries, especially, people are moving to reduce weight of the vehicles. So there is increasing use of plastics, and this is a trend which has been there in the global markets as well. This is something which is happening in India now. Also in India, things are changing with respect to the automobile industry itself. The design, the features, the safety aspects which are required, which have been much more developed in the global markets. So from that perspective, where OEMs are more focusing on providing safety feature, government regulations itself are leading to basically having more stringent regulations on the safety aspects, as well as players' ability to improve features in vehicles and offer better features, will lead to demand for things like sensors, which will require better plastics, engineering plastics. The second thing is from the electric vehicle side. Though we have seen that right now in India, the progress for electric vehicles has not been so positive, but clearly the government has plans to move towards cleaner sources of fuel, and this is an overall agenda that the government has, both on the energy side as well as also on the transportation side. So going forward over the next 5 to 7 years, definitely we are going to see more tractions on the EV side, both on the two-wheelers as well as the four-wheelers front, especially in the public transportation system like three-wheelers and buses. So this opens up a huge opportunity for the engineering plastics and the better quality plastic side going forward.
Okay, thanks. Now I'm getting a lot of questions on the same thing, so I'm going to club them. a lot of specialty chemicals are witnessing an increase in order inquiries driven by global innovators looking to de-risk from, say, a China perspective. How do you see this, and how much time can it actually take for India to scale up and become a leader in this respective segment?
Yeah, so as I mentioned in my presentation also, obviously, most of the countries are looking at de-risking and diversifying their supply chains. And at least in segments like specialty chemicals, where India has a very strong foothold, I think India is very well geared up to, basically take care of this opportunity that comes from the global markets. Players definitely need to make more investments, and which is where some of the better players, the larger players, financially better players, will stand to gain immediately. However, what will happen is that in terms of the raw material side or the intermediate side, India will definitely face issues because India has a high import dependency. In terms of competitiveness, this will play a very critical aspect, as there will be other countries as well, say the smaller countries like Vietnam and others, which would also be competing to get a major part of this share. In fact, some of the capacities are being set up by China in places like Vietnam. So, India will have to really focus on this. There has to be some level of government intervention and support. And the players need to start investing in, setting up capacities to take care of this opportunity.
That's good. Just speaking of how the government is helping, in fact, that comes to my next question. Are there any pipeline incentives for the chemical sector? And how is the government of India, Atmanirbhar Bharat, going to help the specialty chemical sector per se? Are there any things right now that our viewers or listeners can get immediately?
So at present, there are few things which have been talked about. So there is an active demand from especially plastic products industry to levy a safeguard or anti-dumping duty on the industry, as the industry is impacted by cheap Chinese imports. Now there have been some discussions which have been happening at the association level, probably in the current scenario where India has also taken a strong stance to sort of move away the dependence from China. Possibly some of these things will come as a positive. In terms of duties, there is one area where we are looking at, but however, this will not be applicable across the board, because obviously India's dependence on imports is higher, and if you start levying duties, the downstream chemical segment will get impacted. So it has to be a gradual and structured process where in those areas where India has capacities to expand and can immediately gear up to provide to the market. Those are the areas where India can safeguard the domestic manufacturing industry, whereas in other areas, India needs to have a more gradual approach.
Okay, thanks. Now, coming to the specialty lubricant manufacturing segment specifically, which are dependent on base oil, derivatives of crude, and specialty chemicals, which are thickeners and additives. What is your outlook for these guys?
So outlook in terms of prices, if we see, there are two things. So from the demand aspect, clearly there is a hit that the industry will take, the lubricants industry, mainly because the transportation activity itself has been impacted. So it was severely impacted in the first quarter. Second quarter, we have seen some respite, but still it is far below the pre-COVID levels. So this year is where we see things improving from the end of third quarter or the start of fourth quarter. So for the whole year, we see that the volumes or sales for lubricant manufacturers will be impacted. On the other hand, crude oil prices have declined as compared to, say, the last 1 year. So if you look at prices even today, which are trailing at around $43 to $45 per barrel, are significantly lower than what we saw last year. So that will provide some respite in terms of input cost, which is base oil and other inputs that go into lubricant manufacturing. So that will provide some offset to the margin declines that players will see on account of the revenues.
Okay. Now, setting up a chemical plant in India can be a bit of a hassle, where it potentially takes about 18 to 24 months for pollution regulations to be approved. Yeah. Do you think this is one of the negative forces stopping a large chunk of companies to set up new plants? And is there anything the government is doing to ease this?
So I won't say this is the only reason which is stopping players from putting up capacities, but definitely this is one area where India needs to improve. So if you look at China or maybe other developed nations, the clearances process, that is the process to clear proposals, is fairly fast as compared to India. So that definitely is a challenge which most of the industries, not only chemical, but most of the industries face in the Indian context. Though Indian government has been trying to improve the situation through various initiatives, I think still the issue by and far remains. But what has also deterred players from putting up capacities in the past is availability of raw material as well as the cheaper imports from China. So these are also two factors, which is why players have not put up capacities. If I take an example of, say, PVC, India is 50% dependent on PVC. But players have not been setting up capacity on PVC because of availability of raw materials like EDC, which require ethylene, and that ethylene is not available for other applications other than the PE side. So these are also issues which have sort of restricted players from putting up capacity. So apart from the procedural issues, there is also a need to build up that supply chain and scale capacities on the upstream side, which can provide raw material availability to the downstream segment.
Okay, great. I'm going to stick with the government theme here. Now, there is a talk of reduction in MEIS benefits to majority sectors, out of which chemicals is also one. And if MEIS benefits go away, can India's competitive advantage still compete with China, or do we lose that edge?
I will reserve my comments, as I don't have too many points on this aspect.
Okay, fair enough. Now, seasonality in a few FMCD products like air conditioners and refrigerators are lost during the year. How much impact do you think this will have on the primary plastics and specialty plastics? Is there any recovery expected in these segments?
Yeah, so as I mentioned in my presentation also, you'll see demand for especially these appliances fall by around 35 to 38%. Definitely, this will have an impact on the plastic product side and processing side. This year will sort of be a washout because you have already seen the better season. So, for example, air conditioners, the season is mainly the summer season where a lot of sales happen, and that season has been lost on account of lockdowns and closures. So definitely there will be an impact this year, and which is why we see a sharp hit on demand. Probably next year is where we are seeing a sharp increase, which also I mentioned. So we see a recovery of around 40 to 45% in the consumer durable side, and this will be mainly led by economic recovery as well as pent-up demand. So people who have postponed their purchases mainly because of the current scenario, impact on incomes, will probably come back next year once things revive and are in a better shape.
Okay, I think we have time for one or two more questions. I'm going to go be fast with this. What do you foresee from a specialized plastic demand for medical devices, considering, in the kind of times we lead with, medical devices on the rise? Is there a specific specialized plastic demand for them that you foresee?
Yeah, so, I'll not have very specific inputs, but we have seen the pharma segment, which has grown at a very rapid pace over the last 5 years. And with the ongoing pandemic and the other kind of developments which are happening across the globe, you definitely will see pharma sector to sort of grow at a very strong pace over the next 3 to 5 year period. So definitely from that perspective, on the various application side, there will be demand for specific plastics and plastic products which go into the pharmaceutical side. So the long-term prospects on particularly this end-use segment are very buoyant, and we are very, it looks very promising going forward over the next 5 year period.
Sure. I'll just take one last question. What do you think is the impact going to be on the petrochemical market in case there is further disturbance between China and Taiwan?
Actually, I didn't get the question in what context. So, can it be more
maybe we can look at this post the session. We can always answer this post the session in the document that we put out. Thank you so much, Mayur. Thank you so much, Deepti. Thank you so much, Jaideep. And thank you so much to every single attendee today who spent 1 hour of your precious time with us. Before we end, I would like to introduce Elizabeth Master from CRISIL for our closing comments. We'll also be doing a small poll, which is to share your customer feedback post Elizabeth's closing comments. Please do wait for that.
Yeah, thank you, Subhash. In the medium to long term, increase in the export penetration and growth in new applications would drive the specialty chemical space. Moreover, there are prospects to increase the consumption of engineering plastic in the auto industry, as well as the demand support from the food packaging and PPE kits would aid the plastic sector. Thank you all for joining today's session. Stay tuned to the HSBC SME series. The next webinar that we have is on IT and IT-enabled services. Look forward to see you all soon. Thank you.
Thank you, Elizabeth. Please note that we will be sharing the session presentation, the session replay, the session podcast, which is a short 5-minute version of the entire 1 hour. Most of your questions and answers for them, as well as a charticle, which is an infographic which helps you encapsulate today's presentation in just 1 page. All of these will be shared with all registrants, so please be on the lookout for them for the rest of the week. We will be sharing them through the next few days. Again, a very, very big thank you to everyone. Please stay safe and please invest more in the chemical sector. It could be one of the major growth drivers for our recovery. Thank you and see you at the next edition of the SME Knowledge Series by HSBC India with our knowledge partner, CRISIL. Thank you.